Hey, Bernardo, Wealth Extended Family. We're getting a lot of questions around the election. What if this? What if that? Should we increase risks? Should we be more conservative, be taking money off the table? Lots of concern, rightfully so. But we want to go through today just a couple of charts the Capital Group put together to really cut through all the noise and say, well, what if this happens or that? What does history really tell us? So obviously, there's a lot of efficiency. I said this in my last video. There's really not a goal of an administration to have economic downside. And in fact, as you'll see in a minute, it's really a goal and how you get reelected and your party stays in power to have a very strong economy. So whether we're Democrat or Republican, both sides, they do it differently, but both sides still have a very high motivation to have a strong economy and therefore a strong market. So let's just talk about a couple quick things. I added this link into the video so you can read through all this content. But again, this was done by Capital Group. And so here's bullet number one. Markets have trended higher regardless of which party wins the election. And so the very simple chart here shows a growth hypothetical of $1,000 in the S&P index really states that the blue is Democrat and red is Republican. Well, we don't need to pick this this chart apart to see the market is efficient, the market's moving north, and it moves north in blue and it moves north in red. And so again, just staying a part of that, we talk about that all the time. There's going to be volatility in markets, but overall our belief is they do, continue to rise. So that's a good visual, number one. How about if the government is divided? So here's how the market digests that. The S&P index average total rate of return over this period of time, 1933 to 2023, if there's unified government, 14.4% average rate of return through those periods. If there's unified Congress, but a president in the other party, 11.7%. So actually that is what the market maybe, let's say, doesn't like the most, although 11.7 is still a nice rate of return. And then a split Congress, 13.7. So again, outcomes of balance of power, et cetera. Here's your chart to kind of show you that in those scenarios, the markets are still efficient. This is a very interesting one. Markets have tended to predict election results, basically saying that if the market has done well in the 3 months leading into an election, the incumbent party tends to win. There's a higher probability of that. And to me, that makes sense. People want to vote with their wallets. If they feel comfortable economically, they've got a job, they've seen things go like that. That to me makes sense from, again, not a political perspective, just simply an investor behavior perspective. So you can see that chart here. Investors often become more conservative in election years. Man, have we seen this year where the feeling is I don't necessarily want to invest my money with a lot of the uncertainty in the future. And so this chart really just breaks that down and says this is money market versus equity fund flows. This is where our dollars being invested. Well, you can see in a presidential election year, 37 billion in the equity funds or stock funds versus 195 billion in money markets. And then you can see that flip a year after the election, all of that capital gets put to work. 202 billion going to stock market funds versus 85 billion into money market funds. That would also make sense given what we just talked about of, as certainty exists, people want to invest with certainty. The market likes certainty. The market likes to know, okay, here's our president and here's our Congress for the coming 4 years. Now we can plan for this and start to invest and move. So I think that's really the takeaway there. And then lastly, moving to cash in election years can reduce long-term portfolio returns. And so basically this just is a long way of saying, if you try to time these elections based upon solid performance in election years and in non-election years, you're just timing the market just doesn't ever seem to work. So I hope this was helpful. Again, this is really just meant to point out markets are efficient. Politicians want the economies to do well while they're in office, regardless of policy. You may not believe that on one side or the other. In fact, that's what, to me, makes these situations so volatile. But these are the numbers kind of looking back. And I just thought that would be helpful as peace of mind around, hey, if your candidate doesn't win, is that, the end of the world for the economy, et cetera. And I think the answer to that, as proved here kind of over time, is most likely not. So I hope this was helpful, and we'll talk to you soon. Take care.